Welcome. I'm Denise Marshall Miller, AVP of Global Markets and Digital Asset Trading. Today, I have with me Head of Asset Management, Bob Russell, as we distill the noise, looking at the volatility, the tariff wars, the policies, all of these that are impacting the markets. What do you need to do as an investor to navigate this environment? Welcome, Bob. Thank you so much for joining me. Let's get straight into it. So we have seen the U.S. equities market, the S&P, fallen. We have seen the VIX that monitors the fair gauge of what is happening in the market increased. We have also seen U.S. Treasuries at an all-time high. However, investors are not investing. And we're also seeing the weakening of the U.S. dollar. What is happening?
Well, what's happening is that the U.S. administration, when they came into office, they thought that the U.S. economy was being taken advantage of by other nations. So, the current administration decided to take on a policy of increasing tariffs against other countries and, adopting a protectionist stance against...
That's the U.S. first strategy.
Yeah, the U.S. first strategy. So what we have seen, since they took office January 20th, it is an unprecedented increase in market volatility. You saw that, the market reacting to every news item that's coming out of the White House and, reacting negatively generally with the talk of tariffs or the implementation of tariffs. And that culminated on April 2nd, what the so-called Liberation Day, where, tariffs were implemented across, a broad range. I think it was every country in the world got a tariff, and the market reacted, adversely. And when I say the market, the S&P 500, the various indices reacted negatively to that implementation. So since then, there has been talk of a pause on those tariffs. There has been talk of, countries coming to the United States to strike a trade deal. There have been tariffs implemented against China. Unprecedented tariffs, and even since recently, those high tariffs have been cut from the high. So it's a very volatile environment. It's kind of difficult for an investor to say, okay, this is the direction that the global economy is going, and it's a little bit unnerving. So that's why you see the VIX, which is a measure of uncertainty and fear in the market, reaching historical highs.
Yeah.
And so that has caused investors to sort of flee the riskier asset classes and go towards more risk, what we'd call in the investment industry, risk-off assets. Yeah. So that's treasuries and U.S. bonds.
So I would say the main, what is currently happening in the market, what it is showing you is that uncertainty can disrupt a market.
Yes.
Uncertainty for businesses, in order for them being unable to plan effectively, can disrupt their activity. And what we're seeing is generally as a result of the uncertainty, because we're not certain what will happen after the imposition, the imposing of these taxes. How would the other countries relate? What does this mean for companies that have to import goods? What does it mean for their bottom line? And as a result, you're seeing a spiraling effect. It is also shown that just at the start of April, the increase of purchases have skyrocketed because investors are trying to make whatever purchases that they can now so that they're not impacted. So it tells you that the market does not like uncertainty. That's what it essentially saying.
Investors, both on the retail side and on the industrial side, tend to keep their funds in their pockets.
Yeah.
So there's less investment, in factories, in new fleets of trucks, in general expansion of businesses.
Yeah.
As a retail investor, if you're not sure, where the market is going, you tend to want to wait it out and see how it plays out, so that really sort of keeps your investment dollar in your pocket.
Yeah.
And so there's less growth. So what you're seeing is there, with a lot of financial institutions, is that they've cut their growth, their growth outlook for the U.S. They cut it in half. I think at the beginning of the year it was like 2.7%.
Yeah.
I think now the consensus is around 1.4%.
Yeah.
So
the World Bank,
Yes.
IMF has also cut their forecast
Yes.
as well, simply because of these tariffs.
So, as the U.S. implements these tariffs against these countries, they trigger retaliatory tariffs. So what that causes across the globe generally is an increase in prices, and it's an artificial increase, but it's an increase nonetheless. So typically how central banks try to combat this inflation is by raising interest rates. So in raising interest rates, what you see is that it's sort of like a vicious cycle. So you see companies who probably would take the chance in this period of uncertainty, to invest in new factories. They'd find that they'd have to now borrow at a higher cost than they were.
Which would be counterproductive to all the work that would have been done in terms of the US and other countries, including Jamaica, because you were trying to combat inflation, you would have increased. We had different levels of increasing interest rates. And once we believe, or the central banks believe, that interest rate is within a particular range, then you start to scale back.
Right.
Which Jamaica, US, and other countries, Europe has continued to scale back. Up to this week, they did an additional cut. So for the US to do all of that investment to combat inflation and to now have this tariff war that is happening, which could directly spike inflation, would be counterproductive.
Yes, it would be. And one of the things that we as investors and I guess economists in general have not really seen is what would be a win for the U.S. Administration in terms of tariffs. So what would a deal that is satisfactory to them, what would that look like? So having not seen that, you're not sure whether you're closer to a point of stability or not. So it's an interesting time. There is, as you say, a lot of noise in the market. Especially since April 2nd, there has been unprecedented volatility, and it's all related to news on the tariffs.
It
Yes.
has been, but what we want to do is to ensure that we're pointing our investors in the right direction, that whilst there's noise, we need to be able to evaluate the noise and to look at particular metrics to make evaluation. And one such is, and you alluded to it, is the credit spread. and you also alluded to the VIX. Speak to us about the credit spread and what does that tell you as an investor?
So typically, like in normal times, you find that spreads, corporate spreads or corporate bonds have a particular level of spread over what you would call the risk-free rate. So the risk-free rate is usually related to treasury securities. So what happens during these uncertain times is that investors now start to sell securities that have a higher credit risk and go into securities that have a lower credit risk. So what that causes is that the price of the lower credit risk securities tend to go up, and that suppresses the yield. And the securities that they're leaving, the prices of that tend to go down, causing those interest rates to go up. So it's sort of like a measurement of the fear in the market as to how far that spread, widens from normal levels. Okay. So as the spreads widen, you can find some opportunities there. You just have to look at the particular risk band to see, if spreads are widening, significantly more than what it is normal, and you can make a gauge just based on your risk tolerance that this particular band. So, securities typically are graded at an investment grade, and there are several grades within that investment grade band, and each of them have their own typical credit spread over the risk-free rate. So depending on your risk tolerance, you can look to see where you can find value, dependent just based off the current uncertainty here that's taking place, and see where you can position some of your assets in that particular band.
Yeah. So essentially, an investor want to be able to look at a corporate bond that is in line with their investment profile.
Yes.
So if they're considered to be a BB rated investor and they invest in BB rated bonds, if that bond spread widens compared to the US Treasury, that's an indication of fear. That's an indication that investors are moving away from corporate securities because of uncertainty of what is happening. So a good takeaway for investors is to be looking at the spread of their investment, their corporate bond investment compared to the US Treasury, as you noted, be considered to be a risk-free asset.
Yeah. So one of the things is that as you move from what we'd call maybe I should say it this way. So the lower the credit risk is, the higher the risk of default.
Yeah.
So what happens during these times of uncertainty and shift in markets is that companies that are more vulnerable and are on the lower spectrum of the credit risk spectrum, they become a little bit more vulnerable. If interest rates go up, sometimes they can't really manage the increase in the interest rate and their interest expense, so to speak. So that sort of increases the default risk. That sort of puts pressure on the cost of their debt. And, it, as I said before, it creates a sort of a vicious cycle where they tend to start to go down in value. So investors, historically, I've noted this pattern, and I've noted that there's an increase in default risk in times of uncertainty. And as a result, the behavior pattern is for them to move into higher rated credit. So, if you're doing your homework and you're doing your analysis, You can pick companies that are likely to withstand the type of volatility that is currently taking place. So, for instance, in the energy sector, there are companies that would not necessarily be affected by the tariffs because they generate electricity in the United States, they distribute electricity in the United States, but just by the nature of their current credit rating, they're being oversold, so to speak. So it's a way for you to sort of look at these sectors and see, do your homework and say, okay, this is likely to be unaffected. I can, allocate some funds in this sector.
Okay, yeah, that is a good takeaway. So pretty much you're dissecting to ascertain what are those sectors that would not be impacted by the tariff. But still staying on the tariff and the impact, we have seen that to date we have not had any pullback in terms of the tariff. We have had comments coming out of the US president, but no official scale back in these tariffs. But also what we're seeing is that China's president is looking to expand his trading relationships. He would have visited Vietnam, Malaysia, and other countries. We're also seeing in which Europe seem to be benefiting or stand to benefit from trading relationships with China and other countries. China needs to find a market for their products. And there is no doubt that the US has the capability to take that. In the event that there is no reconciliation between US and China, the flow of supply chain, we would have experienced supply chain disruptions in the pandemic. Could this be another reoccurrence? Because can these markets outside of the US be able to absorb the goods that China has? What could this mean for supply chain management from a global perspective?
So the supply chains that currently exist have been developed over decades. They've been developed over, and been formed by the comparative advantages that exist between various countries. And I think that the onset of this trade war will modify those supply chains somewhat. But I still think that they will eventually settle at a point at which the comparative advantages still exist, or to the point that they still still are maintained. So having said that, I don't believe that the rest of the world will be able to substitute fully for the largest economy in the world. I think that there will be new, trading relationships established with other nations, and I think there'd be closer linkages between nations that weren't, formally close. But I do believe that there will still be comparative advantages, as this plays out. I'd use an example. So Colombia, for example, had a tariff imposed on it, and Colombia exports a lot of coffee to the United States. So I'm not sure where in the United States that they grow coffee, but so what you're essentially doing is just increasing the cost of coffee, for the average American consumer. So I'm not sure what is, and I think a lot of people are not sure what is being accomplished, or what is the goal of imposing
So
that tariff?
the president notes that it's to bring back production to the US, but a lot of these companies have noted that it's too costly. So if it's not happening in China, Vietnam could be a possible market. Other markets that are considered to be far less, so that they can maintain their margin. So the probability of the president achieving that objective may not happen because of the cost to do it in the US.
So just to jump in there, so one of the things that we were thinking about when they, the talk of the tariff and how it was being implemented in terms of, like a broad-based implementation, is that, if the United States accomplishes its goal where, unemployment, which was already low, becomes even lower, then the cost of labor will still go up. And the cost of labor relative to the rest of the world will still go up. So if a company is trying to set up a plant, they look to where the labor cost is lowest. So, they would still, go and set up in the neighboring countries that have the lower labor and cost. So how are you going to solve that problem? Is it that you're going to raise the tariffs again? So it's a sort of a
Yes.
cycle, and I'm not sure if it's being implemented properly. I mean, we in Jamaica, we have, significant tariffs on chicken, but it's really, to help, develop the local production, food security, that type of thing. So that is a sort of a targeted tariff, which is implemented to sort of, protect the industry and allow it to develop and flourish and better compete. So tariffs in and of itself is not necessarily a bad thing, but there has to be some type of strategy and end game surrounding it.
Yes, yeah. I agree. So Bob, Jamaica has not been spared. A 10% tax has been levied against us. How will this impact our market, given that we would have gone through a period of hiking interest rates in order to reduce inflation, to combat inflation? We had gotten to a point in which our inflation is within a projected range by our Bank of Jamaica, and we have started to cut interest rate. However, we have not done any since the start of this year. What this imposition of this tariff could mean for us here in Jamaica?
Well, from a competitive standpoint, I don't think it would impact our competitiveness in terms of our exports against our neighbors or other countries that export similar products, because that 10% is really sort of a baseline that was applied to all countries. So
correct.
So we're still at that same level playing field, but generally, as prices increase, you find that there is generally a reduction in demand. So that might affect some of our FX inflows in terms of, to the extent that impacts the demand for our exports. And it
might just be short-lived.
Yeah, it might just be short-lived because, there is uncertainty in the United States. People might be cutting back on their consumption. They might be cutting back on, some other products that, Grace exporting and so on. So there is, there will be some impact, the extent of it which we are not sure, but it sort of still plays back into that whole premise of the noise. How long is it going to last? What type of pattern is being derived from the tariff wars.
Okay.
So I think more so than the impact on our exports. I think that the overall crackdown on remittances and the crackdown on immigration, I think that
would have a greater
would have a
impact.
greater impact, especially more short term, because remittances is a huge part of our FX inflows, and obviously tourism. So if returning residents or residents in the U.S. are afraid of coming back to Jamaica because their visa might be affected or they might be denied re-entry, that would have a big impact on our tourism arrivals and on our FX.
Yeah.
But that in and of itself may be somewhat muted in the short term because our NIR is at
It's quite healthy.
Yeah, it's quite healthy and at historical levels. So it's there's some pressures at play, but there are some factors that would mute that pressures.
I totally agree with you, and we would have also heard our Prime Minister noted that they are negotiating relationships outside, being able to combat this increase. But I do believe that the remittance could have more of an impact because the 10% is across the playing field in terms of our other partners. So that immediate impact may not be there. Okay.
Also, just to sort of add, I mean, the current administration picked, a fight with Canada, so to speak, and you find stories coming out of the United States that visitor arrivals from Canada to the U.S. is down. In some cases as much as 40%. So it might present an opportunity for Jamaica to present itself as a destination to those traditional tourists that used to go to the United States, to come to the Caribbean.
Totally agree with you. So whilst we may see a fall in our remittance, we could see an increase in our tourist arrivals. I totally agree. So this war is all dependent on how we are able to play, so to your advantage. Totally agree with you. Now, with all of that has been said, in terms of the noise that is happening, which really started as a result of this tariff, the imposition of the tariff, the impact that it's having, it could have on inflation, and as a result, the impact that it could have on interest rate. How is it that investors should position themselves in the short term so that they're able to navigate the environment as it relates to their own investment portfolio?
Okay, so when I'm talking to investors, generally the conversation comes back to, what is your risk tolerance? What will keep you awake at night, and what won't. So generally, we try to develop a portfolio that is properly weighted, between fixed income investments, which are considered safe, and equities, which are considered a little bit more risky. And what I would say is that during these times of uncertainty, and the volatility is more concentrated in the equity market, I would say, look for opportunities there to see where you can, sort of add to the equity portion of your portfolio. Warren Buffett often says that, when people are fearful, that's the time you should be greedy, and when people are greedy, that's the time you should be fearful. So this is a time of fear, and you should, sort of look towards
You need to analyze the fear.
the opportunities. But, you know, in these high volatility times, these are times when, I would look towards a trader like yourself to say, what are you seeing in terms of where are assets trading, compared to where they're normally trading, and
Sure.
kind of try to figure out from you as to where to look.
Okay. So with what is happening, Bob, what you're seeing, the US dollar has been losing value. And you're also seeing the stock market going down. You're seeing the US Treasury that is giving you over 4% on the 10-year. Investors are shunning same. And when you compare the US Treasuries to Germany bonds, to UK bonds, they're giving you a higher return, but investors are shunning same. So what it tells you is that investors are looking for an alternative. So in this particular period, and given that this trade war or trade tension has been initiated by the US, what you want to do is to ensure that your portfolio is truly diversified, and especially from a currency perspective. So you want to be looking at adding other currencies to your portfolio. So we have actually seen the euro strengthen. Other currencies considered to be the third currencies have strengthened since this has happened. So in your portfolio, you want to increase the diversification from a currency perspective, and you also want to be looking at companies that would benefit from this trade war that is outside of the US. So the euro market is a good market to look at because it is considered to be the next best to US. We do know that the euro has an energy issue and doesn't make it as competitive. However, that market is there. So you want to be looking at from a currency perspective, and you also want to be adding some commodities to your portfolio.
Right. That's where I was
Yeah. So you want to be looking. Gold is always considered to be a safe haven.
Yes, I noticed that it
And
has
that has
gone
skyrocketed since the start of this year. And if you're not able to buy these commodities outright, a very good alternative is ETFs, exchange traded funds, that you get your exposure to the commodities
and the companies that produce it.
and the companies that produce it. And you can also buy ETFs in companies that are external to the US. So those are some of the ways that you can ensure that your portfolio is able to weather the environment. Navigating the noise is important. It's about evaluating your risk, looking at what is being presented and how you're able to navigate same. And you would have shared some metrics that we're able to use. A credit spread is a good indication when this widens. It tells a story that the increase of fear is there. The VIX, which measures the volatility of fear in the market, once that increase as well, investors need to look on same. And you also gave strategies in terms of how you can position your portfolio to ensure that you're fully diversified, ensure that there are defensive stocks, ensure that you're invested in high quality bonds. But anything additional that you would want to leave with our guests?
So what I would want to leave with our guests is, do not panic. Remember your investment objective. Generally when you started on an investment journey, it's a long-term plan. And, this volatility is I would say, caused artificially, but with the volatility comes opportunity.
Yes.
So, dissect the noise, sift through it, see where you can find securities that have been oversold in this market, securities. If you're a risk-averse investor, you can look in the defensive sectors such as health, utilities, energy, and find securities that you can increase your allocation towards. What we've seen historically is that when there have been significant fall-offs in the market, when they had the subprime crisis, when they had the European credit crisis, the markets have typically bounced back and bounced back a lot higher than they were before. So it's an opportunity for you to get in. What a lot of investment managers look for when when they're investing, like in normal times, you tend to get normal returns, and in abnormal times, if you invest properly, you can get abnormal returns.
Abnormal returns. Yeah, I totally agree with you, Bob. So it's very important for investors to stay close to their wealth advisors. Use this as an opportunity to enter into a particular sector that maybe you have never been before, or maybe it's an opportunity for you to significantly average down. So one of the things that investors need to also ensure that they have cash at their disposal, because it could mean that it's a bargain is there that they need to capitalize on. So the mindset is very important for investors to not only think fair, let us run, but let us remind ourselves what was our objective, what we invested in, review our portfolio with our wealth advisors, our asset managers, our investment professionals, to ensure that we're on track and we're in a position to take advantage of opportunities that will present themselves. Thank you so much, Bob. It has been an absolute pleasure.
It's been my pleasure.
Thank you.
All right.